Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest high-jump in digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to Crypto Republic, bringing you updates every day at noon and 7 p.m. Eastern Standard Time. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. Ladies and gentlemen, for years, XRP holders have asked the same question. If Ripple is partnering with banks, if institutions are building around the XRP ledger, if governments keep talking about blockchain infrastructure, then why hasn't the price reflected it? This week, Ripple finally addressed that question directly. And when you combine that answer with Wall Street-backed crypto infrastructure, shifting ETF flows, and legislation quietly advancing through Washington, a much larger picture starts to emerge. Not a hype cycle, not a meme narrative, a structural transition. Let that sink in, ladies and gentlemen. Because while most investors are staring at short-term candles, institutions may already be positioning for something much bigger. And tonight, we're going to connect every single dot. For a long time, the crypto market has operated in two completely different worlds. There's the retail world, the world of price charts, hype cycles, influencers, meme coins, and emotional volatility. And then there's the institutional world, the world of custody, infrastructure, liquidity routing, regulatory compliance, settlement architecture, cross-border rails, capital efficiency. And for years, XRP has existed in the strange space between those two worlds. Because unlike many crypto assets that was built primarily around speculation, XRP has always been tied to a much larger thesis, the modernization of global payments. That's the core story. And whether someone believes in XRP or not, one thing is objectively true. The conversation surrounding it is changing, not because of social media, because of infrastructure. And this week, multiple developments landed almost simultaneously. Ripple addressed XRP valuation. EDX Markets partnered with Ripple Prime. ETF flow data showed XRP products outperforming major competitors. And legislation tied to blockchain regulatory clarity advanced through the United States Senate. Individually, each story matters. Together, they tell a much bigger story. Let that sink in. But to understand why this matters, we need to zoom out. Because this isn't really about one token. It's about what happens when traditional finance begins integrating blockchain infrastructure into existing systems. And history actually gives us a blueprint for how these transitions happen. Back in the 1860s, during the expansion of the American railroad system, most investors focused on the visible excitement, the trains, the land, speculation, the headlines. But the real transformation wasn't the trains themselves. It was the infrastructure underneath them, the steelworks, steel networks, the financing systems, the standardization of trade routes, the coordination between banks, industry, and government. Once the rails were fully connected, entire industries repriced around the new system. Commerce accelerated, capital moved faster, geographic limitations shrank, and the investors understood the infrastructure phase early were well positioned before the broader market fully recognized what was happening. Now, obviously, crypto is not a railroad, but the analogy matters because major financial transformations usually look boring before they look obvious. That's why I always say, pay attention to what's quiet. And that brings us directly to EDX Markets. Now, this is what most investors miss. When retail investors hear the word partnership, they often assume it's marketing, but the industrial partnerships are different. Institutional partnerships are about access, risk management, compliance, liquidity, and trust. EDX Markets is not a random crypto startup trying to generate headlines. This platform was backed by some of the largest financial institutions in the world: Charles Schwab, Citadel Securities, Fidelity, Paradigm, Sequoia Capital, Virtu Financial. These are firms deeply embedded inside the global financial system. And they created EDX with this very specific purpose: to build institutional-grade crypto market infrastructure. Now, retail speculation, infrastructure, institutional infrastructure, ladies and gentlemen. That distinction matters enormously because for years, one of the biggest barriers preventing large-scale institutional crypto participation was market structure itself. Traditional finance firms operate under strict standards: execution quality, liquidity aggregation, counterparty risk, operational transparency, regulatory oversight. Most crypto exchanges were never designed with those requirements in mind. They were built during a different era. But EDX was designed to resemble traditional financial market architecture: aggregated liquidity, professional execution, compliance-first operations. This is why Wall Street attempting to build crypto infrastructure that feels familiar to institutional capital. And now Ripple Prime is connected directly into that environment. That's the part people should pay attention to, because this isn't just about XRP being listed somewhere. This is about XRP gaining institutional access pathways through infrastructure built by some of the most powerful financial firms on Earth. And that changes the conversation. Short-term noise, long-term structure. That phrase matters, ladies and gentlemen, because price often lags infrastructure. The market likes instant reactions. Institutions build slowly, methodically, quietly. And then suddenly what looked invisible becomes obvious all at once. But here's where it gets interesting. At the same time the infrastructure story was developing, ETF flow data started telling a very different story about institutional positioning. Bitcoin ETF flows weakened. Ethereum products underperformed. Meanwhile, XRP-related products reportedly showed stronger relative inflows. Now, it's important to stay grounded here. 1 week of data does not redefine the entire market. That's not how capital allocation works. But flows still matter because institutional money is deliberate. Large firms don't randomly allocate capital. They move through committees, risk frameworks, compliance reviews, strategic positioning. And when capital begins rotating, even temporarily, analysts pay attention, especially when that rotation involves assets historically considered controversial. Remember, XRP, the anointed one, spent years under regulatory pressure because of the SEC lawsuit against Ripple. That legal cloud changed everything. Many institutions simply avoided exposure entirely because compliance departments could not justify the uncertainty. And regardless of how individual investors felt emotional about the case, the institutional reality was very simple. Uncertainty suppresses adoption. That's true in every market. It's true in banking. It's true in commodities. It's true in equities. And it's definitely true in crypto. So when the legal pressure began easing, the market structure around XRP started changing. Not overnight, but steadily. Custody solutions improved, liquidity assets expanded, institutional products increased, and perhaps most importantly, the conversation shifted from survival to integration. Price is reacting, system is evolving. That distinction is critical because many investors confuse volatility with progress, but infrastructure development rarely looks exciting in real time. It looks incremental, technical, sometimes even boring, until suddenly the network effect compounds. And history gives us another example of this. In the late 1940s, after World War II, the Bretton Woods system fundamentally reshaped global finance. Most ordinary systems didn't understand the significance immediately, but governments and financial institutions did. The creation of coordinated monetary frameworks, reserve structures, and settlement agreements transformed international commerce for decades. The real power wasn't visible in one day's currency movement. It was embedded in the architecture. The infrastructure determined how value moved it globally. And again, crypto is not Bretton Woods, but the parallel is important. When financial infrastructure changes, markets eventually reorganize around them and the new framework. That's the deeper conversation happening around blockchain right now. Not just prices, systems. And Ripple's comments about XRP's valuation fit directly into that broader theme. Let that sink in. Now let's talk about the statement that got everybody talking. Ripple was asked directly what XRP's price remained relatively low. And their answer was straightforward. They believe value could grow over time. Now, some people dismissed that answer instantly. They wanted a dramatic prediction, a huge target, a guaranteed timeline. But public companies operating under regulatory scrutiny do not speak casual about asset prices, especially companies that have spent years fighting the SEC. The context matters, ladies and gentlemen. So when Ripple frames XRP as a long-term infrastructure component tied to global payments, investors should understand what they are actually communicating. They're emphasizing utility, longevity, adoption, infrastructure, not speculation. And whether someone agrees with Ripple's vision or not, there are legitimate structural reasons why XRP's price performance has historically lagged expectations. The circulating supply is large. The token model emphasizes velocity. Write those two things down. Institutional adoption faced legal barriers. A broader crypto market spent years dominated by speculative narratives rather than utility-based valuation. Those realities matter, but here's what may matter even more. The infrastructure environment around XRP today looks dramatically different than it did 5 years ago, and that shift is becoming harder to ignore. Now, this is where Washington enters the story, because regulation has always been the hidden variable inside crypto adoption. Everybody talks about technology. Few people talk about legal clarity, but institutions absolutely do. And this week, Congressman Tom Emmer confirmed that the Blockchain Regulatory Certainty Act has been incorporated into the Senate version of broader digital asset legislation. This is huge, ladies and gentlemen. That development could become extremely important over time because one of the largest obstacles facing blockchain developers in the United States has been uncertainty surrounding liability. Someone develops decentralized software. Are they acting like a financial intermediary? If someone operates infrastructure, are they suddenly subject to banking laws? What exactly defines a broker, a validator, a node operator? For years, these questions created a chilling effect across the industry. Capital hesitates around uncertainty. Builders relocate. Innovation slows. And institutions wait. And that's why legislative clarity matters so much. not because laws automatically create adoption, but because legal frameworks reduce uncertainty, and reduced uncertainty invites capital. Now, this is what most people miss. Institutional adoption is not primarily driven by excitement. It's driven by risk assessment. Large firms don't ask, could this asset go up? They ask, what are the legal, operational, liquidity, and reputational risks associated with exposure? And that's a completely different mindset. And when governments begin clarifying how blockchain infrastructure can legally operate, the risk profile changes gradually, then suddenly. That's how systematic adoption often unfolds. Not in one giant argument, but through a series of infrastructure decisions that solely remove friction from the system. And XRP sits directly inside that conversation because of its long-standing focus on payments and settlement. Now let's pause for a second and separate speculation from structure, because this is important. None of these developments guarantee future price appreciation. No one knows exactly how markets will behave. Crypto remains volatile. Regulatory environments can still shift. Crypto remains intense, and adoption curves rarely move in straight lines. But investors are increasingly watching structural indicators instead of purely emotional narratives. Institutional integrations, liquidity architecture, regulatory clarity, ETF products, cross-border settlement initiatives. Those are measurable developments, and they tell us far more about long-term positioning than daily social media sentiment. But here's where the psychology becomes fascinating and spicy. Most investors emotionally anchor themselves to price alone. If price stagnates, they assume nothing is happening. Yet throughout financial history, the biggest transformations often occurred quietly before markets fully recognized them. Think about the early internet. During the 1990s, many people focused exclusively on volatility tech stocks. That's all they liked. But beneath the surface, something much bigger was happening. Fiber optic networks were expanding. Data infrastructure was being built. Protocol standards were developing. Server architecture was improving. Those infrastructure layers ultimately became the foundation for trillion-dollar digital ecosystems. The analogy here is not that XRP becomes the internet. The analogy is that infrastructure phases often appear underwhelming before their network effects mature. And that's the core thesis many long-term XRP supporters are watching. Not whether today's candle is green, but whether institutional rails continue forming around blockchain-based settlement systems. Now let's discuss another critical dimension, liquidity. Because liquidity is the lifeblood of modern financial rail systems. Without deep liquidity, large-scale institution participation becomes difficult. Execution costs rise, slippage increases, markets become inefficient. This is one reason Ripple has consistently focused on liquidity solutions and cross-border settlement architecture. The goal has never simply been creating another speculative token. The broader vision involves enabling efficient movement of value across the fragmented financial systems. That's a fundamental infrastructure-oriented objective. And whether the market fully prices that in today or not, institutions are clearly exploring these capabilities, especially as tokenization conversations accelerate globally. Because tokenization may become one of the biggest financial narratives in the next decade. Governments, banks, asset managers, payment firms, everyone's studying how real-world assets could eventually move across blockchain-based infrastructure. Bonds, treasuries, commodities, equities, real estate. And if tokenized assets increasingly require interoperable settlement rails, then networks optimized for liquidity and cross-border efficiency become strategically relevant. Again, no guarantees, but the direction of travel matters. And institutions appear increasingly interested in that direction. But the real shift came when crypto stopped being viewed purely as an alternative asset class and started being viewed as financial infrastructure. That's the turning point. Because infrastructure receives a completely different kind of attention. Governments care about infrastructure. Banks care about infrastructure. Regulators care about infrastructure. Pension funds care about infrastructure. Infrastructure shapes economic systems, ladies and gentlemen. And that might explain why legislative conversations around blockchain are becoming so much more serious. The United States, Europe, Asia, and the Middle East are all increasingly competing to define digital asset frameworks. Nobody wants to completely miss the next phase of financial technology. And at the same time, nobody wants uncontrolled systematic risk. So policymakers are trying to balance innovation with oversight, messily, slowly, sometimes inconsistently. But the process is clearly advancing, and XRP's relevance inside the process comes from its positioning around payments and interoperability. Now, this is where we need to discuss one of the biggest misunderstandings in crypto investing, ladies and gentlemen. People often assume utility automatically equals price appreciation. That's not necessarily true. Markets are more complicated than that. Valuation depends on countless factors: supply dynamics, demand, velocity, market psychology, macro conditions, liquidity, regulatory treatment, speculative cycles, institutional access, global risk appetite. So even if blockchain adoption accelerates broadly, different digital assets may perform very differently. That's why separating narrative from evidence is essential. And this is also why serious investors focus on probabilities rather than certainties. Could XRP benefit from expanding institutional infrastructure? Possibly. Could regulatory clarity help adoption? Potentially. Could increased liquidity access improve market depth? Yes. But none of these outcomes guarantee a straight line of future. Markets rarely move that way. Still, the structural developments themselves remain important. And when you connect all the dots from this week, the pattern becomes difficult to ignore. Wall Street-backed firms are building compliant crypto access points. ETF products tied to XRP are attracting attention. Legislators are advancing blockchain clarity frameworks. Ripple continues positioning XRP as a long-term infrastructure and institutional conversation, and tokenization and settlement are accelerating globally. That combination creates a very different environment than the one XRP existed in during the peak of the SEC conflict. Write that down. Let that sink in, ladies and gentlemen. Now let's talk about patience, because patience is one of the hardest psychological skills in investing, especially in crypto. The market trains people to chase volatility, fast moves, immediate gratification, constant excitement. But infrastructure investing historically rewards a different mindset, longer timelines, deeper research, understanding system rather than headlines. And some analysts believe XRP's long-term thesis depends almost entirely on whether the infrastructure vision ultimately materializes, not whether retail enthusiasm spikes temporarily. That's an important distinction, because hype can move markets quickly, but sustainable institutional adoption usually develops slowly, then compounds. And here's another historical analogy worth considering. During the construction of medieval trade networks across Europe, merchants who controlled bridges, ports, and settlement routes often became more influential than the traders moving individual goods. The infrastructure-enabled commerce created lasting strategic power. Today's blockchain networks are competing to become digital infrastructure layers for future value transfer. Different technology, same strategic principle. The systems facilitating movement can become extraordinarily important. Again, that does not guarantee any one project wins. Competition remains fierce, but it explains why institutions continue investing billions into blockchain infrastructure despite market volatility. Because they are looking beyond short-term speculation. They are evaluating future financial architecture. Now that brings us back to the core question. Why has XRP's price historically remained lower than many holders expected? The simplest answer may actually be the most realistic one, because markets often require infrastructure maturity before broad repricing occurs, especially when legal uncertainty delays institutional participation. That doesn't mean repricing must happen, but it does explain why infrastructure developments matter so much to long-term investors. Ladies and gentlemen, if the ecosystem expands, if liquidity deepens, if regulatory clarity improves, if tokenization accelerates, if institutional settlement demand grows, then the conversation changes, not emotionally, structurally. And structure is ultimately what institutions care most about. Now, this is what most people always miss. The crypto market may still be early in separating infrastructure assets from purely speculative assets. For years, almost everybody and everything moved together. Bull cycle, bear cycle, risk on, risk off, blah, 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 blah. But as the market matures, differentiation could increase. Networks with institutional integration may eventually be evaluated differently than purely retail-driven ecosystems. That transition has already happened in traditional finance countless times. Emerging industries began chaotic. Eventually, infrastructure leaders separate from speculative noise, and the next few years could reveal whether crypto is entering that stage. And that's why the current moment feels significant to many observers. Not because of guaranteed outcomes, but because the foundations underneath the industry appear to be evolving rapidly. Compliance frameworks, institutional custody, liquidity architecture, ETF structures, tokenization pilots, cross-border payment systems, regulatory legislation. These are not meme cycle developments. These are structural developments, and structural developments tend to matter long after headlines disappear. So where does that leave XRP, the anointed one? Some investors remain skeptical. Others remain deeply optimistic. Both sides will continue debating adoption timelines, valuation models, and utility assumptions. That's normal. Healthy markets require disagreement. But one thing seems increasingly clear. The conversation on XRP is no longer just about speculation. It's increasingly about infrastructure. And whether that infrastructure eventually translates into broader market repricing is the question institution analysts and long-term holders are all watching. Because underneath all that volatility, underneath all the headlines, underneath all the social media arguments, a larger financial transition may be slowly unfolding. Slowly. Keyword slowly, ladies and gentlemen. quietly, systematically. And if that transition continues accelerating, then the assets position close to the institutional financial rails could become increasingly important over time. Again, no guarantees, only probabilities, only structures, only signals. And right now, many investors believe those signals are becoming harder to ignore. What I always say, short-term noise, long-term structure. I always say, pay attention to what's quiet, even though it's boring, like watching paint dry on the wall. That may ultimately define this entire era of crypto. So when you step back and connect everything we covered today, the picture becomes much clearer. Wall Street firms are building compliant crypto infrastructure. Legislators are advancing regulatory clarity. Institutional products tied to XRP are attracting increasing attention. And Ripple itself continues framing XRP as a long-term infrastructure asset tied to the future of global payments. That doesn't guarantee immediate price action, but it does suggest the system underneath the market is evolving. And sometimes the biggest financial shifts happen long before the public, broader, fully recognizes them. So the real question investors need to ask themselves, when will price move? I want to hear from you. The deeper question is, what kind of financial infrastructure is being built right now in front of us? I want to hear from you. What do you think? Because once you understand the infrastructure story, the short-term volatility starts looking very different. The large financial system may already be slowly repositioning underneath them. Short-term noise, long-term structure. I always say this. Prices reacting, systems evolving. If you enjoyed this breakdown, make sure you subscribe, hit the like button, and join the Wolfpack. And let me know in the comments. Do you think crypto is entering its infrastructure era, or a market still trapped in speculation mode? Because we're tracking the macro shift, the institutional signals, and the structural changes most people overlook. Always do your own research. Never invest based solely on a YouTube video. And remember, short-term noise, long-term structure. I'll see you in the next one, and pay attention to what's quiet. Don't get caught up like sushi. Don't FOMO things. We are the remora. We feast on the sushi. Remember that, ladies and gentlemen. This content is for informational and entertainment purposes only and should not be taken as financial advice. Always do your own research and consult a licensed financial advisor before making any investment decisions, always. Remember, ladies and gentlemen, the game is changing, and those who understand it first will benefit the most. Make sure you're on the right side of it. You have two choices. You can be like the crowd, reacting after the move, rationalizing why they missed it, telling themselves to never happen again, or you can be the one who saw behind the curtain, the one who understood the infrastructure shift, the one who positioned early, not randomly, but intentionally. Because some moments in history are loud, but the ones that change everything are quiet right up until the moment they're not. And this is one of those moments. Do not blink because the world is distracting you with noise. While XRP continues developing behind the scenes and building momentum in the broader digital asset landscape, stay sharp, stay informed, accumulate knowledge. Your move now will be remembered. This is not the end of the story. This is just the beginning. This opened your eyes. Smash the like button, ring the bell, and leave a comment with your thoughts. Turn on notifications, and most importantly, subscribe to the Crypto Public. We break down the major global banking trends shaping digital assets today, giving you context, clarity, and research you can use. Don't just watch history happen. Stay informed, stay ahead, stay in the public. I love you all. See you on the front lines.